So that's the kind of market we are talking about. Satish Ramanathan is joining us now to analyze all of that for us. Satish, afternoon. Thanks for joining us, and it's so nice to see you after a very long time. Satish, global worries on one hand, and domestic support system like crude coming down below 85 on the other. How are you looking at the market right now? Is the risk reward turning favorable?
Thanks for having me online. Thanks. It's been a great opportunity. Just a couple of things that we are thinking is that this interest rate hike is having its own ramifications over time. And what is happening is that on the margin, savers could shift from equities to debt and fixed income securities. And that would have an impact on equity flows. That is one part that we are concerned about. On the other hand, as you rightly mentioned, India is in a sweet spot because commodity prices are cooling off, inflationary pressures are cooling off. Our trade deficit seems to be an area of worry because that seems to be expanding, especially ahead of the festive season. So pressure on our trade deficit seems to be an area of worry because that seems to be expanding, especially ahead of the festive season. So pressure on commodities, pressure on currency is one aspect that we need to worry about, and the flows is the other aspect that we need to be concerned about. So that's the balance that we are striking. From a portfolio perspective, we are backing good consumption names, play on rural India. The tier 2, tier 3 towns seem to be picking up pretty well. We are seeing this across the board in terms of Amazon sales, Flipkart sales up 28% over the past 2 days. So I think we're just keeping our fingers crossed and taking it step at a time.
Satish, how are you analyzing the valuations of benchmark index as well as valuations of various parts of the market? Where do you see highest valuation support? The 1 or 2 year forward earning versus the kind of tailwinds or triggers some of the areas actually have?
I think there's been a fair degree of time correction that has taken place. On a 1 year basis, the Nifty has given almost flat or slightly negative returns. And that's true across many benchmarks. And consequently, what has happened is time correction has taken place and markets have actually become cheaper to that extent. Where we see valuation support are clearly in financials, because financials, the NPLs, provisioning cost has come down and credit growth has picked up. So in terms of valuations, they are looking cheaper, spare 1 or 2 banks. But that's one sector that we are looking at. The second aspect where we see valuations reasonable with safety is the IT sector, because we think that even though IT sector may face international headwinds, the currency hedge that it offers is required from a portfolio perspective. So I think overall we are balancing consumption, IT sector. We also think the corporate capex is showing some early signs of revival, and therefore corporate capex is a segment that we are looking at keenly. As and when valuations turn favorable, we would be looking to add there.
How are the conversations panning out? Your conversations with some of the corporates? I was just looking at SRF, just for example's sake, the amount of capex which this company is likely to make versus what they've done in the last 20-25 years is 3-4x. So when you meet managements who are preparing beyond the 1 or 2 year, who are preparing 2 to 3 year plus kind of a call, what kind of conversations across sectors you're having with some of these corporates who are looking slightly longer term in their lines of business or cycles?
I think we're seeing this taking place in the chemical industry significantly. We are seeing corporate capex pick up. Just today morning, we had an analyst call with all our internal team, and we found that corporate capex in the chemical space is very strong. If you look at the capacity utilization of corporate India, it has crossed 72%, which it has after 2019. So after a long time, corporate capacity utilization is improving, and companies will need to plan. We are seeing this clearly taking place in the chemical space. Some of the FMCG companies such as Nestle, etc., have also reported a large amount of capex. And I think we will have to look at sectors where this capex is taking place. We are also seeing capex in the unlisted space, for instance, what Vedanta is doing with Foxconn, or some of the other groups setting up semiconductor facilities or solar panel facilities. That may not be necessarily in the corporate listed space, but in the unlisted space. So corporate India capex is surely picking up, and we need to ride that wave as well.
Right. So what are your thoughts on the small and mid-cap end of the market? They traditionally are very high beta. They fall very fast. They rise very fast. But when the earnings starts moving, the earnings engine depends on which company we're talking about, that acceleration is also pretty high, and hence the multiple expansion. Are you finding comfort in dipping into certain sectors in the mid and small or even micro, or you wouldn't go in that direction right now?
You brought up a very valid point, and actually the small and mid-cap space has shown its resilience in this volatile market. In fact, there are two reasons for this. One is corporate India's balance sheet has improved significantly. The debt to equity levels of mid-cap and small-cap companies have come down considerably, and free cash flows are going up, and borrowings have come down as well for this. This has reduced earnings volatility. The second aspect that we need to understand is that the small and mid-cap segments of the market have typically attracted retail investors. And with the groundswell of retail investors backing mid-caps, the erstwhile volatility that we saw in mid-caps has come down. In fact, on bad days, we find, other than the last few days, in most of the recent times, we found that mid-caps outperformed large caps during bad days. And that is a clear indication that the volatility that we were speaking of in mid-caps has come down considerably. However, the liquidity risk of mid-caps still remain. And as mid-caps become more and more expensive, when there is a negative news, then mid-caps tend to fall sharply. So we need to bear that in mind as well. But the volatility that we saw in mid and small caps in the past has come down considerably.
Satish, before we let you go, give us a sense of where have you been buying in the last couple of weeks. Where are the areas which interest you and you are looking at deploying additional funds?
I think our deployment of additional funds has been in the backdrop of the global macro. The global macro headwinds that we are facing in terms of higher interest rates and a stronger dollar has predicated our decisions. And the decisions that we have taken are to increase tactically a little bit of IT because they have fallen and they have huge cash flows. And also in terms of looking at companies with strong consumption businesses as well. So we have the traditional financing companies which aid consumption, such as ICICI Bank, SBI Cards, things of that sort, as well as we have the consumption companies such as Jubilant Foodworks, and a couple of other companies in that category as well.
Right. Satish, just a last word on the macro front. October 13th is when the next US CPI data is due. And we were looking at the data ingredients of the last negative surprise on the US CPI front, which came from shelter. Housing rents have not really fallen the same way. they usually fall into the gap. All the other energy, the biggest fall, commodity, food had been slightly sticky. Do you see that in the next 2 to 3 months, US CPI will also tip off or roll over? Is market pricing in that or not yet? Now, the bigger worry is recession.
No, that actually is the conundrum that we are facing, because if you raise rates, investments don't follow, and corporates actually hold back. And capacity creation is the best way to actually remedy inflationary pressures. And what we are seeing in the US house rent market is that capacity creation has dried up completely, and people searching for rent are now struggling to find houses, and therefore rental yields have actually moved up to keep up pace with the interest rate hike. So it's a very delicate balance that central banks have to follow. They need to ensure that the supply side is also increased and demand side is discouraged to bring down inflation. So what they're currently doing is to curb demand by raising rates, but they have a tightrope to walk because supply has to move up as well.
Right. All right, Satish, thanks very much for your time today and your inputs. We'll chat up once again, perhaps offline, but thanks very much. Nice to have you on the show today. Take a short break, but before that,